Delving into dividends, unpacking the mysteries of the SCHD ETF. Investing in the stock market, for all its potential rewards, can be a daunting pursuit. Navigating the complex world of equities, choosing individual stocks, and navigating market fluctuations can test even the most seasoned investor. This is where exchange-traded funds, ETFs, come into play, offering diversification and simplified access to various market segments. Among these, dividend-focused ETFs have gained significant traction, promising a steady stream of income alongside potential capital appreciation. One such ETF that frequently piques investor interest is the SCHD Schwab US Dividend Equity ETF. So, is SCHD the silver bullet for your income-seeking portfolio? What lies beneath the ticker symbol? Let's dive into a Q&A format to unpack the mysteries of this popular ETF. What is the SCHD ETF? Launched in 2011, SCHD is a passively managed ETF offered by Charles Schwab. It tracks the Dow Jones US Dividend 100 Index, targeting the 100 highest-yielding stocks within the large-cap segment of the U.S. equity market. This focus on established, dividend-paying companies aims to provide investors with a stable source of income while minimizing volatility. How does SCHD work? As a passively managed ETF, SCHD doesn't actively pick individual stocks. Instead, it passively mirrors the composition of the underlying index. The index provider, SP Dow Jones Indices, regularly reevaluates the list of eligible stocks based on dividend yield, free float market capitalization, and liquidity. What are the key characteristics of SCHD? Here are some key features of SCHD. Focus on high dividend stocks, investing in large cap companies with established track records of consistent dividend payments. Diversification, exposure to 100 different companies across various sectors, reducing the risk associated with any single company underperforming. Low expense ratio. A competitive expense ratio of 0.06% translates to minimal fees eating into your returns. Quarterly dividend payments, regular income distribution, allowing for reinvestment or supplementing your cash flow. Liquidity, high trading volume ensures ease of buying and selling shares. What are the potential benefits of investing in SCHD? Investing in SCHD offers several potential benefits. Steady income stream. Consistent quarterly dividend payments can provide a reliable source of income, particularly for retirees or income-oriented investors. Long-term capital appreciation. While not guaranteed, the underlying stocks have historically shown potential for long-term growth, offering both income and capital appreciation. Risk mitigation. Diversification across large-cap companies with established track records helps mitigate volatility compared to individual stock picks. Lower management costs. The low expense ratio minimizes fees, maximizing your returns. Are there any potential drawbacks to consider with SCHD? While attractive, SCHD is not without potential drawbacks. Lower total returns. Compared to growth-oriented strategies, SCHD may underperform in periods of strong market rallies. Limited growth potential. The focus on mature companies may restrict the ETF's growth potential compared to smaller cap, or technology-focused ETFs. Concentration in specific sectors. The underlying index can be heavily weighted towards certain sectors like consumer staples or utilities, potentially exposing you to sector-specific risks. Dividend sustainability. Dividends are not guaranteed, and companies within the index might adjust or suspend payouts in challenging economic conditions. Who is SCHD suitable for? SCHD is a good fit for investors with the following goals: income generation, retirees, income-dependent individuals, or those seeking a steady stream of income to supplement their expenses. Risk-averse investors, individuals seeking diversification and lower volatility compared to individual stock picking. Long-term investors, those with a long-term investment horizon focused on income and gradual capital appreciation. How should I compare SCHD to other dividend-focused ETFs? When comparing SCHD to other dividend ETFs, consider the following factors: underlying index. Different ETFs track different indexes, leading to variations in sector allocations and dividend yields. Expense ratio. Lower expense ratios translate to higher returns over time. Dividend payout frequency. Some ETFs offer monthly or semi-annual payouts, while others pay quarterly. Investment objectives. Align the ETF's characteristics with your specific investment goals and risk tolerance. Beyond holding SCHD, what strategies can I employ to maximize its effectiveness? Dividend reinvestment. Reinvesting your dividends allows for compounding returns, amplifying your income over time. This strategy is particularly effective in the long run. Pairing with growth ETFs. Consider diversifying your portfolio by combining SCHD with a growth-oriented ETF to balance income generation with potential capital appreciation. Tax-advantaged accounts. Utilize tax-advantaged accounts like IRAs or 401(k)s to hold SCHD, minimizing your tax burden on dividends. Are there alternative dividend ETFs I should consider besides SCHD? Certainly. While SCHD excels in its specific niche, several other excellent dividend ETFs offer different features and benefits. Here are a few alternatives. DVY, SPDR Dow Jones Dividend ETF tracks the Dow Jones U.S. Dividend 100 Index, similar to SCHD, but with slightly higher expense ratio and dividend yield. HDV, High Dividend Value ETF invests in undervalued U.S. companies with high dividend yields, offering the potential for additional capital appreciation alongside income. SDY, SPDR SP Dividend ETF tracks a broader index of high dividend stocks across various market capitalizations, providing wider diversification than SCHD. Looking ahead, what are some potential challenges or opportunities for SCHD and dividend-focused investing in general? Rising interest rates. Higher interest rates may make other income-generating assets like bonds more attractive, potentially diverting investments away from dividend ETFs. Economic uncertainty. Economic downturns can impact corporate profits and dividend payouts, leading to reduced income from dividend-focused strategies. Changing dividend policies. Companies may adjust or suspend dividend payments, affecting the overall performance of dividend ETFs. However, alongside these challenges, opportunities also emerge. Growing demand for income. As populations age and seek retirement income, the demand for reliable income streams, like dividends, is likely to continue growing. Focus on ESG. Increased focus on environmental, social, and governance factors can lead to the development of dividend ETFs that align with ethical investing principles. Technological advancements. Innovation in financial technology can lead to more efficient and cost-effective ways to access and manage dividend-focused investments. In conclusion, what should I remember about SCHD and dividend-focused investing? SCHD offers a compelling option for income-oriented investors seeking stable dividend distributions and portfolio diversification. However, it's crucial to remember that no investment is without risk, and careful consideration of your financial goals, risk tolerance, and alternative options is essential before making any investment decisions. Remember, the world of investing is dynamic, and continuous research and assessment are key to navigating its complexities. With informed choices and a long-term perspective, you can harness the potential of SCHD and other dividend-focused strategies to achieve your financial objectives.